Hello, everybody. So today I want to briefly cover StoneCo, STNE. STNE is a company that I've been following for years, and really the stock has not moved for years. But when I look at the underlying business of StoneCo, I am just pleased and happy with what I am seeing. And September for me is a month where I want to increase my allocation to StoneCo because this stock is very, very, very cheap. It is, in fact, the second cheapest stock as far as the style of that I invest, right after HIMS. And actually, StoneCo has been down a little bit. If you compare both stocks, you can see it's almost a very similar valuation. We're paying very little for that forward growth. StoneCo is a company with incredible growth, and it's a stock we often forget about, right? Analysts are predicting revenue growth of 40.14% over the next 12 months. And that's based on Seeking Alpha. And we know analysts are not kind to any type of growth company and any type of tech growth company. StoneCo is a tech growth company. Analysts are not kind to this type of company, and they give a 40%. In my last video on StoneCo, if you've seen it, I estimated that the growth could be as high as 52%. I estimated 52% growth for this company over the next 12 months is what I'm seeing. So if I were to take both metrics, a negative metric and a bullish metric, because I'm fairly bullish on the stock, cut it in the middle, we'd be at 45% forward growth for this company. So this is a company that is growing really fast. And this is where the margin of safety comes in, and where I think this stock, in my view, could be a home run because it caters to two separate shareholder bases. It caters to the value investor shareholder base and to the growth investor shareholder base, because these growth numbers, they're better than most SaaS stocks. They're outstanding, these growth numbers for StoneCo, right? Absolutely great. But these EBITDA yields are also absolutely outstanding. I mean, it seems to me, it's a joke, right? But it seems to me that they're in the cash piling business. The cash piling is going very well. And if you saw this video where I covered EBITDA yield over 30%, sales growth of 30%, I only found StoneCo in there as a long-term business that is consistently able to bring these two. There's actually more businesses that come up when you do that search in the screener, but these are not businesses that are very long-term growth. Oftentimes the business I've found that fit this screener are commodity-based businesses. And what happens is the price of a commodity went up 50%, and thus it fits this criteria because the commodity went up 50%. No, this is a consistent grower with compounded growth and with a product that clearly follows a traditional product adoption curve. And if you look at those yields, if you look at those adjusted EBITDA yields, which are a proxy for cash flow. Adjusted EBITDA is a proxy for cash flow. If you look at that, you're at 29% adjusted EBITDA yield, and next year's adjusted EBITDA yield is 48%. All of this for a business that is projected to grow revenues at 45% next 12 months. 45%. Like, this is stunning. Whenever I see this type of EBITDA yield, you typically expect this to see this on a highly leveraged pipeline stocks. That's going to be on the verge of bankruptcy. That's typically the type of business where you see these yields, or a tanker, an oil tanker stocks. High leverage, great EBITDA. That's a typical type of business where you see this. Very seldom do you see an EBITDA yield like this on a growth company. In fact, I have never seen that before. Keep in mind, this is a real company. This is a company that is providing permanent payment terminal, right? A service we're very used to in the US and very used to in Europe, and a service that Brazilians are becoming very used to as well. They're providing payment terminals like this, right, at checkout for your restaurant or your small business, whatever, and 2.962 million businesses use that product. Almost 3 million. Let's round it up. 3 million businesses, 3 million terminals is what StoneCo has installed in Brazil. And there's still a tremendous room for growth. They have a competitor, PagSeguro, the main competitor, but they're kind of in a duopoly. You know, that's okay to have competition when the pie is growing. You can have a little bit of competition. You have Mercado Pago, who's a little bit of a competitor and who's having a product also that comes into the physical retail space. But I mean, when you're dealing with such a growth market, you can have competitors. That's okay. That's fine. You can have competitors and still have outstanding returns and still grow. Like, keep in mind, this is a company, and I can't understand this. Square, if you live in the US, these Square payment terminals, there's competitors to Square everywhere. There's competitors to Square everywhere in the US, right? Maybe, I mean, when I shop at small businesses, maybe one small business out of 3 will use Square. Over times, they'll use other systems. There's competition with Square too, just like StoneCo. StoneCo has competition, but StoneCo is trading at a 3.4x enterprise value over EBITDA. Square is trading at a 21.3x enterprise value over EBITDA. I can't understand this. You know, sure, there's the Cash App. The Cash App probably explains a lot of that valuation, but even if you remove the Cash App, I still can't understand it, right? Brazil is a very big market, well over 200 million people living here. Sure, the US is a little bigger, but that still doesn't explain. US is bigger at 340 million, but that still doesn't explain that difference. Like, this, to me, this is a major difference that I can't explain. And Square is not a company that's growing at 45%, right? Square is growing at 10-ish% right now. Their growth has stalled. StoneCo is growing at 45%. So I don't understand. Why this stock is so cheap. I just can't understand it. I don't get it. And I'm not a value investor. So I don't invest in StoneCo for the cash pile. I own StoneCo because of forward growth expectation and because I think this is a stock whose chart will very much look like the product adoption curve of their underlying service and product, which is that payment terminal. And I also understand why the stock has been down 87%. I mean, at least in the beginning, right? It was down because they've made a mistake. They've lost nearly $500 million because of a Brazilian collateral system for small business. And they've made that mistake, but they've moved on from the mistake. They've fixed the issue. They've done all of the internal checks. They have a new CEO, new management. Like, this is behind them as far as business goes, but Wall Street still has to catch up to the fact that the issue that they had with the collateral in early 2021, that issue is not there anymore, but the stock is still down 87%. I think this is a stock that needs to be rediscovered, and I'm happy to rediscover or discover this stock before the market knows about it. I think, and this is the point of my video here: is could the cash pile, because we know traditional finance, TradFi, is all about value and value investing. It's still very prevalent, even though I don't think it's the way to go, and I don't think it's a way to invest, and I think it's an inferior way to invest, value investing. There you go. But there's still a large portion of traditional Wall Street that loves value investing. And could value investing force StoneCo to be re-rated up? Could it force the stock up? Well, briefly, back of the napkin math. This is not precise. This is a short video I'm making today, but back of the napkin math. Let's look at it. This is a company right now who's trading at a 3.22 price to cash ratio. The price to book ratio, and price to book is one of the most 20th century accounting metric you can get. And if you read Ben Graham, they love price to book, right? That equipment costs money. You got to buy the business for the cost of the equipment and the cash. Price to book is a measly 1.32. Cheap. It would get on a value investor's radar in 1960. That's how cheap this stock is, right? The net cash current position is 364 million. Now, keep in mind, they have long-term debt, but that debt matures in a while. And we use price here when I do price to cash, so I don't use enterprise value. So going back to a more widely spread metric, which is price. I prefer EV, but that's my own idiosyncrasy why I prefer enterprise value. But if you go back to that and calculate net cash, you're at a net cash position at 264. It's just a different way to penalize the company for debt, essentially. You could use price and calculate net cash, or you could just use EV and entirely do away with debt. But the way I do it, the way I use it is it doesn't matter. The point is, if you assess this company like a traditional company and you accept that they have debt and the debt is fine and that's leverage for them, you look at the cash position. The cash position is 870 million in cash position that this company has, 870 million. And they are projected to add to that cash pile. In Q3, they should add, if you translate these reais and 99 million, and of course it's an approximation because they may spend the cash for a few things, but in my view, it's very credible that they'll add $99 million in Q3. $99 million in Q3. So if I round that up and I keep in mind that the client base for this company has consistently grown, keep in mind, this is a company, 12 months ago they had 2.06 million small business users. Today they have 2.96 million business users. So there's been a tremendous increase in the adoption of the product. So these numbers are going to go up. So if you go back here and you imagine over the next 12 months, what if they had another $400 million to that cash pile? And then add another 12 months. What if they add another 500 million to that cash pile? And then add another 12 months. What if they add another 600 million to that cash pile? You're adding $1.5 billion to the cash pile in 3 years. That's why I believe the market will wake up one day and re-rate this stock just by virtue of that cash pile. You know, I would much rather see them invest that cash pile in marketing, invest that cash pile in the future growth of the business. In fact, I would even rather see them do buybacks at this point, at this level. But the market at some point will notice that cash pile. I don't think this is going to be a stock that's going to end up trading at 1.5 times cash. And with time, not only is it a stock whose revenue grows really, really fast, but whose cash pile grows. So anyways, I'm not a value investor. I'm a growth investor. I like this company for the growth. I like this company because it's culturally relevant in Brazil. This business is growing, you know, like a weed in Brazil. And that's why I own the business. But those cash metrics are absolutely outstanding. And to me, this is a big plus of owning this stock. The margin of safety that has to do with that cash pile. They have too much cash. That's the conclusion of the video. Anyways, not investment advice. This was just entertainment. Hope you were entertained. Appreciate your likes. Appreciate your subscribes. Have a wonderful day, and thanks for watching.